All right, I believe we are live. Let's see here. Let's see, where's this chat? Get the live chat going here. All right.
You're live, so.
Let's see here. Welcome, welcome. Just looking. Cool. All right. So we are live. Welcome to the Open Economy Initiative's DeFi workshop. My name is Matt, and I'm joined by my co-founder, Chill Brimer.
Hi, I'm Chill.
And yeah, we're really excited that you guys have joined us tonight. We spent quite a bit of time putting this together, and we're excited to see what you think and get some of your feedback. And it should be a good time. We'll definitely be taking some questions from you. And so yeah, just follow along, and we'll specifically note when we're taking questions kind of after each little big section that we get through. And yeah, that's pretty much it for the ground rules. Before we hop into it, I do want to just share a little bit about who we are at the Open Economy Initiative. We're on a mission to promote crypto commerce through education, which is why we're presenting this information on DeFi. And we're a community based in Colorado, but we're spread out all through the United States. And we do a lot of these fun meetups. Obviously now it's virtual with the whole Corona thing, but we hope to be doing some live ones at different places when everything opens back up. But for now, we'll be online, and this is where you can find us on our YouTube. And yeah, that's pretty much it. Chill's got a section. I know. So we've got a pretty big presentation for everybody. We've actually split it into two parts. So tonight we're going to cover the first half of it, and when we get to the outline, I'll show you which half we're covering. But next week, same time, same place. So Thursday, December 17th, 7 p.m. Mountain Time or 6 p.m. Pacific, we'll be presenting the second half of the DeFi workshop. There's just so much stuff to cover. We want to make sure we're doing it correctly and getting everybody up to speed on it, because it's really exciting. There's a lot of fun things going on in the space, and then obviously the markets are kind of coming up, so there's new people coming in, but the world of DeFi is a little bit intimidating. The learning curve can be sort of steep, so let us kind of guide you through it, and hopefully you'll be a little bit further ahead than you would be otherwise. So yeah, that's kind of it for the intro. We can just hop into it. I'm going to present some slides, and I think to keep Zoom from putting my face over the slides, I'm going to stop my video here. So just give me 1 sec. I'll share my screen and we'll get into it.
You muted yourself.
I think, can you still hear me? I think I'm still talking. Can you hear me?
Okay, cool. I cannot hear anything.
Oh yeah, sorry. I'm just I lost my Zoom window. There we go. Okay, let's see. Okay, can you see the big slide there, Chill?
I can see it on Zoom. I don't see it yet on YouTube.
Ah.
It may just take a minute.
No, I think it's. Oh wait, yeah, there it goes. Okay, it looks like it popped up. Looks like there's kind of some. Where's the?
Okay, I can see it now. Perfect.
Okay. All right. Cool. All right, so I can't see the chat, so you gotta.
I covered the chat. Just
Cool. All right, so this is our DeFi workshop, and we're going to be diving into decentralized finance. It's being brought to you by the OpEI, which is Matt and Chill. What we're going to be covering, this is for part 1 and for part 2, is going to be, what is it? What is decentralized finance? What are the benefits? So, kind of what are the benefits versus traditional finance? And then what are the use cases? How do people use it? And then we get to the how-to, so how you can actually use it and benefit from it, potentially profit from it. And then with the final section is a confidential special surprise. So you'll have to tune in next week and see what that is. But tonight we're just going to be covering the basics. What is it? The benefits, and we'll get about halfway through the use cases, and that's probably going to take about an hour to an hour and a half with the questions. And then next week we'll finish up the use cases. We'll do like a live, well, I don't know if I'm going to do a live demonstration or a recorded demonstration. But yeah, we'll show you exactly, how to use it, and you can follow along at home if you'd like. And yeah, get into the space and actually, start earning a little bit with the decentralized finance ecosystem. So should be pretty fun. Yeah, so first slide here, what is it? Decentralized finance explained. Well, you can think of it like finance. I know, shocking. So, any service that allows you to borrow, lend, exchange, send payments, do other traditional financy things, and then kind of take that and wrap it all up inside a digital, decentralized, permissionless, and peer-to-peer system. So while these terms, digital, decentralized, permissionless, peer-to-peer, are often enough to convince executive boards to dump tons of money into something they don't really fully understand, you at home are probably wondering, what do these buzzwords actually mean? So we'll go through them here. Digital just means that we're all doing this online using our computers. Fairly simple. It's digital and not analog or physical. Second one there, decentralized, just refers to the fact that the network we're using to do all these digital things is supported by many different nodes or computers that are spread out around the world. So people in different countries on their computers are supporting this network that we're how we're accessing and using this decentralized finance ecosystem. Third, we have permissionless, which is my favorite one on the list here. And it's awesome because it means that you don't need anyone's permission to participate. Literally, an internet connection and a crappy computer or a smartphone means that you're in. And also, credit scores not required at all, which makes this space incredibly inclusive. It's very easy to get involved and use the different protocols. Finally, we've got peer-to-peer, and this is describing how this type of finance works. So there's no middlemen who are taking a cut. Rather, if I want to lend to somebody, I'll be able to directly lend to them something of value, and they'll directly pay me the interest. It comes, out of my self-custody wallet, and then the benefits and the profits come right back to it, and there's no centralized third party in the middle, taking a little bit of a fee and driving the costs up for everybody. So because DeFi is digital, decentralized, permissionless, and peer-to-peer, this space is able to do things that traditional finance can't or simply won't because they're just not able to. All of DeFi is run on code in the form of smart contracts that are executed by a global decentralized network of computer nodes. This means that any developer can deploy a new financial product or a platform while being assured that it cannot be censored or taken down, which is really a major breakthrough for the billions of people who are currently underserved by financial services. It makes it very robust, and yeah, it's just open to anybody, which is really, really cool. And lastly here, because this type of finance is run off of code, never before seen opportunities are emerging with things like flash loans, synthetic assets where you've got a token that represents like a real world thing, or even a coin from a different blockchain, something like that. And then you've got these stable coins that are algorithmically balanced to maintain a peg to some other asset or currency. These are a few of the things that the DeFi system is able to do that is a lot harder for the traditional financial world to do. It makes it pretty cool and exciting. And yeah, today there's nearly $15 billion of value that's locked up in the DeFi ecosystem. And this trend is really only expected to accelerate. There's quite a few new people coming into the space. The price increase overall in crypto definitely helps. But seeing a lot of these institutional companies like MicroStrategy and BlackRock get into this as a hedge against the dollar deflating, and seeing PayPal offer support for it is a pretty good sign that this stuff is kind of growing in the awareness of the broader public. So it's a great time to get into it. This space is really only projected to grow, and it's kind of crazy to think about, a year from now, and a little over a year from now, January 1st, 2022, what is this chart going to look like? We started at under a billion 2020, and we're up at 15 billion. Who knows where this is going? But I'm pretty excited for it, and I'll definitely be trying to take advantage of it. So that's kind of the what is DeFi. And I don't know, Chill, are there any questions in the chat about that explanation, or everybody pretty good? We can kind of keep rolling on here.
Yeah, looks like everyone is already invested. So
nice. Okay, cool. Well, yeah, so this slide here is the benefits of DeFi, and there's kind of two ways. We hear benefits. There's two ways to think about it. It's like, how do I personally benefit from it? But we're going to actually get to that and kind of the use cases and the how-to section. So the second way that is kind of geared for this slide is, what are the benefits that DeFi unlocks compared to the traditional centrally controlled finance? So the answer to this is more buzzwords. We've got immutability, programmability, transparency, interoperability, and self-custody. What do they mean, and how does it make you $1 million? Just stay tuned. But yeah, I don't know. Jokes aside, these properties, they are important differentiator. So it's worthwhile to know what they mean. If you're already familiar with them, it's not bad to have a refresher, because they're pretty much everywhere at least in the crypto space. So we'll start with immutability. This simply means that once a service or a program is deployed into the DeFi ecosystem, it becomes immutable or tamper-proof. This can be a good thing, or if you've improperly coded a program, it can be a bad thing. But at the end of the day, it's immutable. It's not going to be tampered with once it's out there in the wild. So the performance of the service is going to be the same today, tomorrow, or years from now, which allows you, the user, to trust that it'll do what you expect, and that your account balances are going to be accurate, and takes a little bit of the risk out. There are some other risks that kind of offset that, but the immutability of the system and the protocols running on it is definitely a good thing compared to the traditional world, where it's a little less, you're a little less confident that it'll be the same today or tomorrow. From a technical perspective, this is also a benefit when you think about auditing the smart contract. That's going to add even more security, checking to make sure everything is correct before it gets deployed out into this immutable state. So second one is programmability, which is just referring to the fact that anybody can code a smart contract and then order it to do a variety of different things. Things like automatic order executions, the creation of synthetic assets, many other financial tools that are possible with this programmability. It's just kind of up to your imagination to figure out what you want something to do, and then you program it, and it's out there for everybody to use. And we'll get into a little bit more of that in the use cases as well. Third one is transparency, and this is simply the fact that all the code that's used to create and deploy these DeFi products is 100% open source and available to anybody. So, any value that's moved from account to account is going to be visible, and it allows anybody to really track the activity that's happening on the network, like what public address is pumping token and dumping it, or how much value has flowed from this protocol into the other protocol. There's just a lot of cool things that you can do when all of the data is open and transparent, and there's some great websites out there that aggregate it and put it in a nice visual format for you that makes it even easier. So. Fourth, we've got interoperability, and this is what allows the different DeFi projects to integrate with each other and benefit each other. So you think of the quote, like the whole is greater than the sum of the parts. That is definitely applicable in the DeFi space, where you have a protocol that's maybe allowing you to borrow against some collateral, and then you have another protocol that's allowing you to exchange what you've borrowed for a different asset or cryptocurrency, and then you can do even more things with that. It's I think what's everybody say? It's like the money Legos is sort of how they refer to it. Everything's kind of stacks on top of each other, and you can use the different protocols that are all interoperable, and you get something that's more valuable than just kind of the sum of the individual projects. Lastly is self-custody, and this is just referring to the fact that these funds are held in your own wallet that you are the custodian of. So you're not trusting someone else to hold this for you, which is a good thing in the sense that you are ultimately in control of what happens to your funds. And it can be a negative though if you're not taking proper cybersecurity precautions, and keeping your private keys safe, or using a hardware wallet, because you can use a hardware wallet to access MetaMask and do a lot of these things on the Ethereum DeFi ecosystem. So it's more responsibility for you, but you get more control, and you don't have to worry about somebody taking your funds to invest on your behalf and then running off with you. So it reduces a little bit of risk that way. Yep. How's the chat looking, Chill?
Great. People are interested about yield, and it sounds like a lot of folks are very familiar with the DeFi space. So I think you can keep going until we get
get to the use cases probably. Okay. Cool. So now that you should have an idea kind of about what DeFi is, what sets it apart. So we can get into the use cases, which is the fun part. And I kind of think of these as the useful ways that you can benefit from using DeFi. And small disclaimer, this is by no means a comprehensive list. We're just kind of put the majority of the services into these 5 buckets of lending, decentralized exchanges, stablecoins, assets, and payments. If you want a more inclusive list, definitely check out DeFiPrime.com. They've got quite a few. They just kind of break it down a little bit more, and there you can see the specific projects that are doing kind of these different things in these different areas. So just a quick run through here. First up, we've got lending. This also includes borrowing. Fairly straightforward. If somebody wants to lend, they need somebody who wishes to borrow. And because lending and borrowing is a foundational part of any economy, the protocols for DeFi lending and borrowing are the most widely used, and that's where the majority of the value is locked up. Second are the DEXs, which are decentralized exchanges where you can trade one cryptocurrency for another. The cool part about these is there's zero KYC or identity verification that's required to use these exchanges. And because they're run in a decentralized manner, they're impossible to shut down, which is very cool. And they're going to interact directly with your wallet, which will allow your funds to stay under your control, kind of that self-custody point that we made earlier. That's going to be a good part of using, or a positive part of using, a decentralized exchange for sure. Third, we've got stablecoins, which are a currency that's just pegged to another currency or asset. I'm not going to get too deep with this, but you should know that the world governments are getting into the stablecoin business with these things called CBDCs. And Chill will actually be presenting kind of a breaking that down for us once we get to that portion of the use cases. So, yep. Fourth, we've got assets, which are just a token that's held in your wallet. They can be tied to a real world asset or a digital asset that's usually in the form of a cryptocurrency. There's gold backed ones. There's some synthetic assets where you've got a Ethereum token that is pegged to Bitcoin. And, obviously Bitcoin and Ethereum are on their own separate blockchain networks. But with a wrapped Bitcoin, you can actually use a Bitcoin token that corresponds to the real world or the actual price of a Bitcoin in the Ethereum ecosystem, which opens up a lot of different options that you wouldn't have if you just had to stay within Ethereum. So and also these being tied to these real world assets, like stock indices and different things like excuse me, different things like that really opens DeFi up to people who previously have not been able to invest in these types of things just due to geographic or financial restrictions. And then, lastly, the assets, digital assets are the fuel for the DeFi derivatives market, which is it's growing pretty rapidly here in the last few months. And so, lastly, we've got peer-to-peer payments. And these are the foundation. I mean, this is the foundational use case for crypto. If you have read the Bitcoin white paper, which is the first and still the most successful cryptocurrency out there. I mean, it's peer-to-peer electronic cash is what's right there at the top. So peer-to-peer payments are a foundational part of the cryptocurrency ecosystem and kind of by proxy for the DeFi ecosystem. And the payment solutions that are out there right now are creating a more open economic system for a lot of the underbanked and unbanked people. But they're also helping larger businesses and corporations streamline their payment services, just with fast settlements, borderless payments, things like that. So that's an important aspect of the DeFi system to know about. So that's kind of the brief run through on these use cases. And now we're just going to kind of take a deeper dive into some of the more popular protocols for each one of these points. So we'll start out with lending. These two are my two favorite, I guess. There are some other ones that do similar things, but this is what we're going to be covering right now for the use cases. And then when we get to the how-to section next week, we'll actually go through and open up a CDP and trade something on Compound. It'll be pretty fun. But for now, I'm just going to provide kind of an explanation of what you can do on each of these platforms, and we'll take questions after I get through the next two slides. So if you're not understanding something, please put it in the chat. I know we have some people who sounds like they're fairly advanced, but I do know there are some people who this is like their first exposure to DeFi, and I want to make sure that you're understanding this. And don't hesitate to ask a question. There are no dumb questions, even if it seems like a lot of people are further ahead than where you are. Don't worry about that. So there's multiple lending protocols in the DeFi space, and we could take a long time in going over all of them, but we're just going to focus on Maker and Compound here tonight. First up is Maker, and arguably I think they're like the very first DeFi project ever. I want to say. I think so. I can't think of somebody that came before them. But basically what Maker does is they allow you to lock up some Ethereum or some other Ethereum-based ERC20 tokens is what they're called. And you use these as collateral. And then when you lock them into the Maker smart contract, you'll receive DAI, which is a stable coin pegged to the US dollar. You'll receive DAI at an over collateralized ratio. So for example, if you locked $100 worth of Ethereum into Maker, you would receive $33 of DAI, which is you could receive more, but you want to do about a third of your collateral. So you lock up $100, you get $33 worth of DAI out, and then you can do whatever you want with that DAI. You can cash it out through Coinbase, send it to your bank account, go buy some lunch, You can do whatever you want, but if you want to get that $100 of Ethereum back, you're going to have to go back to Maker, pay them that 33 DAI they originally lent you, plus a little bit of interest, and then at that point, the Ethereum will be sent back to your wallet. So, if you want to buy a car or something, you got $30,000 worth of Ethereum, lock that up, mint about 10 grand worth of DAI, cash that out, buy your $10,000 car, and then you have basically an unlimited period to pay that loan back. But you're going to be accruing interest. I think it's like 2% a year right now. So not a ton of interest, but you will be accruing interest on that loan. And so, when you want to unlock that Ethereum, you just have to pay them back the original amount of DAI they lent you plus a little bit of interest, and you get your Ethereum back. So yeah, that's kind of a brief rundown on Maker. They're primarily a borrowing service where you put collateral in and you receive a loan that you must pay back to have your collateral returned. The nice thing is this locks you in at the current price of your collateral. So if you locked, one Ethereum in to Maker when the price was like $100 per Ethereum, when you go to pay back the DAI that you received, you only have to pay back what you took out. And if the price, comes up, you can actually take out more DAI as the price appreciates. But you've got to be careful because if the price comes down, you run the risk of getting liquidated. So, yeah, the liquidation, the risk, that's the main risk that you run when using one of these lending or borrowing platforms is liquidation. And it works great when ETH is appreciating and going up in price. Your collateral is becoming worth more and it's easier to pay it back. But when it goes down, liquidation kind of enters into the equation. And what does that look like? Well, if you see here, this is just the dashboard for Maker right before you set up your CDP or collateralized debt position. And so you can choose what type of collateral you want to. This is not a complete list, by the way. They have a bunch of different types of collateral. But we'll just say we're going to choose Ethereum A. And it has a 2% stability fee, which is just the interest rate annually. So whatever they give you, whatever loan you take out, it's going to be a 2% annual interest. And then you have this thing called the liquidation ratio. So if you put in $100 of Ethereum and you took out $50 worth of DAI, you will be liquidated when the value of your Ethereum is 150% of the DAI that you took out. So you take out $50 worth of DAI, liquidation ratio is 150%. 150% of $50 is $75. So if you remember, I just said that you put Ethereum in when the price was $100. So, and your liquidation on your $50 is going to be at $75. So if the price of Ethereum drops from $100 to just below $75, you're now an automatic liquidation, and they are going to sell your Ethereum that you've locked up. And they will give you some of it back, the equivalent of it back, but they're going to take a 13% liquidation fee, and they're also going to take out that $50 that was originally given to you. So you don't want to get liquidated, but what is nice is Maker allows you to put a bit more Ethereum in or a bit more collateral in. So if you are getting close to that liquidation ratio, that price is coming down towards $75, put in a little bit more Ethereum, and then maybe you get it down to $60 or $55 before this automated liquidity or automated liquidation kicks in, and you lose 13% of what you've put in. So yeah, that's kind of the basic rundown of Maker. It's fairly straightforward to use. I know it used to be like really complicated before they went to like multi-collateral DAI, and they had a bunch of hoops you had to jump through, but you'll see next week when we go through and actually make one of these, it's pretty easy now. Definitely compared to what it used to be. So yeah, that's the main risk with Maker is liquidation. And there are some other like broader systemic risks that apply to most DeFi protocols, but I'm going to get into that at the end of it and just kind of stick to like protocol specific risks as we go through and explain these.
So there are a couple questions before you move on.
Yeah.
So number one, why would I lock up $100 for $33? That's number one. Number two, so the loan price is the DAI, not the maker. And and if you could explain again a little bit about the rates, the liquidation, slower. So do you get one-time DAI by locking up Ethereum? And is it a monthly or a yearly yield?
Okay.
And I can send you these questions in Keybase so you can see it yourself.
Yeah, if you could do that, because I've got like a full screen presentation here. So if you send them to me in Keybase, I'll do it. But one of the questions was why would I lock up Ethereum? Like why would I take out an over collateralized loan? Why would I put in more collateral than I can get out for the loan? And that's, because like when you go to the bank or when you go to buy a house or something, you put down maybe 10% or 15%, then you get a loan for like way more than that collateral that you've put down. So yeah, it doesn't quite make sense right out of the gate. But an example that I like is kind of a hedge against yourself making a bad investment. Sorry, I'm going to take a drink of water here. Just one sec. So so I'm going to run through an example here. So let's say that I've got 10 Ethereum and the price of Ethereum is $100. So I've got $1,000 basically worth of Ethereum, 10 Ethereum, and $100 each. I go into Maker and I lock 10 Ethereum into a collateralized debt position, and then I receive 333 DAI. So I put in $1,000 and then I get 333 DAI out. That $1,000 worth of Ethereum, that 10 Ethereum, doesn't go away. It's there and I can take it back once I pay my loan back. But for now, I've got 333 DAI in my wallet. I can do whatever the heck I want with that. So I take it over to BitConnect, or I guess I would have to convert it into Bitcoin first. But let's say I put it into a scam investment. I lose all 333 of that DAI on a poor investment. 1 year later, Ethereum is now worth $300 per Ethereum. So that 10 Ethereum is now worth $3,000 that I locked in there. And at this point, I've got to pay 377 DAI, which is my initial 333 that they gave me, plus I think 4% interest, or what's that, 12% interest. So that's much higher than you'd actually have to pay. But so I've got to pay back 377 DAI on that 333 DAI I originally took out. So, at the end of the day, I've got $3,000 worth of Ethereum that I can unlock by paying $377, which nets me $2,623. So, I've lost a bunch of money on this awful investment that I made, but I'm actually only out 12.5% of my original 10 Ethereum investment. I still have, almost 90% of what a little under 87.5% of my original investment. So that's scenario number one using a CDP. Scenario number two is 10. We go back to a year prior. 10 Ethereum is at 100. It's $100 each. So that's $1,000. I sell 3.33 of that Ethereum to receive 333 DAI. And then I take that 333 DAI, send it over to BitConnect, and instantly lose it. 1 year later, that Ethereum is now at $300 per Ethereum, but I only have 6.66 Ethereum left, which is worth just under $2,000. So I've actually lost 33% of my original 10 ETH investment. So, by taking out that collateralized debt position, I'm able to use my Ethereum and keep investing it. It doesn't just sit there in my wallet doing nothing, but I've hedged against, a bad investment. And this is assuming that the price of Ethereum has gone up over a year. So if you think that Ethereum and the crypto space in general is going to appreciate in value over the period that you want to take to repay your loan, then it's a great idea to take out a debt position against it, because it really hedges against whatever you decide to do with that, and it lowers your risk of doing it versus just liquidating at whatever the current price is, and then time goes on, and that crypto that you've liquidated is worth more, but you have less of it if you make a poor decision with what you've liquidated. So hopefully that makes sense. Let's see what the other question is here. Can immutability be used to counter censorship? If you publish a piece of information, it can never be removed. Yes to both of those. So immutability is a great way to counter censorship. Like, it doesn't matter if they like, if I'm a smart contract developer, excuse me, I'm a smart contract developer, and I push a DeFi protocol out there that allows people to, I don't know, do something that the government doesn't like, I guess. They can come and find me and be like, hey, you made this smart contract, you need to take it down. And you can't do it. It's already out there and it's running. And if you didn't code a kill switch into your smart contract, it's going to continue running, and they can do whatever they want to you. But there's no way for them to actually stop that smart contract from performing whatever it is you programmed it to do. So that's how the immutability can counter censorship. And then, yes, if you publish a piece of information, it's in there forever if it's contained within a blockchain. If that gets mined into a block, that piece of information is in there. What a lot of people do is they take the excuse me, the hash of some data, and so it's basically a fingerprint for a big block of data is what the hash is, and then that is put into the blockchain, and then later on you have that same chunk of data, and you say, hey, look, like, this is the same data that we had before. And then somebody can hash it out and compare it to that hash that's stored on the blockchain. They can say, oh yeah, the hashes are the same. That means that the data that was originally mined into it a year ago is the same as this data you're showing me now. And that hash will be there forever as long as that blockchain network's still running. I mean, you can verify that information is the same. So yeah. Let's see here. We got another one. So the loan price is the DAI, not the maker. Yeah. So the maker, it is a token that you can purchase, but it's like a governance token. So, maker is run by a DAO, which is just the community of holders who hold the maker token, and they get to vote on what the interest rate is for your loans. Different parameters that kind of govern how the maker ecosystem works. And things like that. So yeah, the maker token is used for governance. And I guess in like a black swan event, I believe that maker is sold to maintain that dollar peg for DAI. So if like DAI is really, really getting beat up and it's not worth nearly $1, which is what they want to maintain, I believe that maker starts getting sold and then like bought back to kind of balance it out to make sure that the DAI stays at $1. Yeah. So do you get a one-time DAI by locking up Ethereum? I'm not sure what that one means. Is it a monthly or a yearly yield? So the interest that on the on this screen here, the stability fee, that's interest, that's annual interest, and you're being charged that on your loan. So you're getting your 33 DAI out. And you're being charged 2% of 33 every year, but I believe it accrues like each block. So like every 10 seconds in the Ethereum blockchain. I think it's every block. They might do like epochs. I am actually not sure how quickly it accrues, but over the course of a year, you will owe 2% on that loan. That I know. You lock up 100. Could you explain that again? The rates, liquidation, etc. only slower. So it's let's see here. I do want to keep it moving because I know Chill's got a hard cutoff here, and we do have some more information to cover before we get onto it. But let's see here. Yeah, I would say for that one, I mean, so basically the example. Let's see, the interest rate adjusts. So for Maker, the interest rate I believe is set by the token holders. The stability fee is voted on by all the Maker holders. For Compound, which we'll get into in a second here, it's going to adjust. It's going to be variable based on demand. But for Maker, I believe that stability fee is voted on and set by the holders of the Maker token who are able to vote using their token. Yep. So, okay, can you explain that again? The rates liquidation only slower. So I'm debating whether you should just go back and watch the recording or if I should explain it again.
Good, I think, yeah, just explain it.
Okay. So let me pull, look at this here. Okay, so to take out a and I'm gonna go through this whole process like live next week. So if you don't get it this time around, I'm gonna move on. But tune in next week and you're gonna actually watch me do this, and it might make a lot more sense if you just kind of see it done live. But so we've got so I go to Maker and I have some Ethereum that I want to take out a loan on. And so I'm going to choose collateral type A here, which is Ethereum A. So I'll check this little box. I am agreeing when I deposit this that I'm going to pay 2% interest on whatever DAI that I take out. And then I see here the liquidation ratio is 150%. So I put in $100 worth of Ethereum as collateral. That's my collateral there. And I receive $50 worth of DAI on that $100 of Ethereum I put in. So my liquidation ratio is going to be 150% of whatever I've received. So I've received $50 of DAI times 150% or 1.5. That equals 75. So if the price of my collateral goes to $75, drops below $75, I should say, I'm now at risk of automatic liquidation. So I've put in $100, I've borrowed $50, and if the price of the initial collateral, where F is trading at the open market, drops to $74.99, I will be automatically liquidated, and Maker will take a 13% fee. So what they'll do is they sell that Ethereum, which is now only worth $75. They get $75. They take their 13% fee out of that, and then they also take the $50 worth of DAI out of that. So I'm left with like 0.2 Ethereum plus $50 worth of DAI, assuming that I haven't spent it or whatever. But that would be how a Maker CDP works in liquidation. But what I would recommend is don't take out $50, just take out $33. Or if you do take out $50 and the price starts dropping, put a little bit more Ethereum in there, and that will and don't take out any more DAI. Put some collateral in and don't take out any more loan, and that will lower the price at which you get liquidated. And it tells you in the dashboard as well. Like once you set this up, it'll tell you what price you're going to get liquidated at, and it'll tell you, okay, add this much more collateral to get to like a healthier ratio. So it's fairly intuitive once in practice. But yeah, I'm just speaking theoretically here, so it could be a little tougher to wrap your head around. Is that all the questions, Chill? Should I move on?
Yes, that's all. I think it relates back to the concept that you're not making payments and you don't default, so it's kind of hard
there's
for
no monthly. That's an important distinction. Like there's no monthly like payment that you have to make. There's nobody like coming to collect this. If you never pay it back, your Ethereum's just going to sit in there and you'll never be able to move it. It'll be locked up, and then eventually the interest rate will force you into liquidation after like 10 years or something. It depends on how much DAI you took out. But eventually the interest rate, the amount of interest that you owe, will reach a point where Maker just liquidates you because your collateral is not worth enough of your loan plus the interest. But yeah, there's no monthly fee. You can pay it back whenever you want. You can pay it back tomorrow and you'd have, just a fraction of 2% interest owed, or you can pay it back a year from now and owe 2%. But it's accrued. Yeah, it's accrued like block by block. So like every 10 seconds is the interest is adds up, but it's very, very small amounts. So, yep. Okay, so that's Maker. That's going to do it for Maker. And I'm going to move on to Compound now. So Compound, along with Aave, AAVE, and there's a few other ones as well, but they're going to allow you to not only borrow, like what we showed with Maker there by putting up some collateral, but if you want to lend to other people, they'll allow you to lock up a bunch of different ERC20 tokens, including DAI, Ethereum. This is not a comprehensive list. This list goes way down. I just couldn't fit it all in the screenshot. But you can put in a bunch of different types of collateral. And then you see right there, there's the AP, the annual percentage yield. So if you put in Ethereum, you're going to be earning 0.06% annually on it. If you put in DAI, you'll be earning 3.2% on it annually. If you put in Compound, which is the platform's native token, you'll be earning 3.1% annually. So, if you're trying to stay less risky with your investment, but you don't want it just like sitting idly in your wallet, you could convert it into one of these that have a good yield or something that you think might appreciate, and then you can earn a little bit of interest on top of what you already own, and it's paid out in the same thing that you put in. So if you put in Ethereum, the interest is going to be paid out in Ethereum. If you put in Basic Attention Token, the interest is going to be paid out in Basic Attention Token. And it happens when you withdraw, so it doesn't start like adding up immediately. It's just when you go to withdraw it from the Compound smart contract, you'll get back your original amount plus whatever interest that you've accrued for lending it out, or lending it to the pool where other people can use it. So yeah, the process of lending is really simple. You literally select which asset that you want, you deposit it with like a couple clicks through your MetaMask or your wallet, whatever you want to do, and then you just wait for the interest to accrue. And the interest rates do fluctuate. This is just what they currently are. And this, I think that was a question in the other one, like the interest rates are variable. I think on Aave, they offer like fixed interest rates and also variable interest rates, but for Compound, they're just variable interest rates, and it's all based on demand. So, you can see Compound and DAI have a higher yield if you deposit some in there and lend it out. That's because way more people are trying to borrow Compound or DAI versus Basic Attention Token or Ethereum. So that's how that's calculated. It's just, purely demand based will drive up the amount that you can earn. Versus how many other people are also doing it, because Ethereum is very popular to put in there, and so it's just supply and demand. It's fairly simple for the lending side of it, the borrowing side of it. For the lending side of it, the supply side of it. For the borrowing side of it, it's a little bit more complicated, but not by too much. So it works the exact same way as lending. You pick a asset, one of these things that you want to, one of these ERC20s that you want to deposit, put it in there, just like you would if you were going to lend it out and earn interest on it. But then as soon as you've put it in there, you can check one of these little boxes to use it as collateral and then borrow against it. And it's going to be a similar type of setup as with Maker. In terms of how it's an over collateralized loan. So you're not going to be able to borrow the full amount of what you've put in as collateral. But you can, what makes it a little bit more unique and easier to come up with some, profitable strategies with is that you can put in any token on this side, and then you can borrow any token on this side. So it's not like Maker is just like, you can put a bunch of different things in as collateral, but you can only get DAI out With Compound, you can put a bunch of different things in, use it as collateral, and get a bunch of different other ERC20s out. And so, a pretty popular way to use Compound is to use it to actually short or long a trading pair, give yourself a little bit of margin. So like if you wanted to long the Ethereum versus basic attention token pair on Coinbase to use a centralized exchange. I know I keep saying Coinbase, but you could so that's my example. So you deposit some Ethereum into Compound, and you use it as collateral, and then you would take out a loan in basic attention token. So you put in a little bit of Ethereum, you get out a smaller amount of basic attention token, and then that BAT goes straight into your wallet, and you can do whatever you want with it. So you immediately send it over to Coinbase, deposit it into Coinbase, where you go to their Ethereum BAT pair. I think they have one. They may not, but we'll just assume they do for this explanation. And then you immediately sell your basic attention token for Ethereum on Coinbase. So you've deposited some Ethereum, you've used it to take out a basic attention token loan, and then you take that basic attention token and send it to Coinbase, where you immediately sell it for Ethereum. And so in this scenario, you are hoping that the price of Ethereum will increase relative to the price of BAT. And then if that happens, you've got some Ethereum on Coinbase, the price of BAT goes down relative to that Ethereum. So you can now buy back all of the BAT for your loan, and then you'll have a little bit of Ethereum left over. And then you come back to Compound and you close out this loan by paying all of the BAT back plus a little bit of interest. And at this point, you still have some extra Ethereum on Coinbase. And then you pay this BAT back, and then you unlock your Ethereum. And at the end of the day, you've got more Ethereum than what you started with. So that's and you're trading on margin versus just going directly to Coinbase or Uniswap and selling your BAT for Ethereum. And to short it, it's just the opposite. So if you wanted to, that what I just described was longing Ethereum and was longing Ethereum BAT on the F side. If you wanted to short it, you would just deposit basic attention token, take out an Ethereum loan, send that Ethereum to Coinbase, and then immediately exchange the Ethereum for basic attention token. And then you're hoping that the price of basic attention token comes up relative to Ethereum. And then when it does, you're able to unwind everything, and you'll be a little bit in profit. You'll have a little bit more basic attention token than you started with. And you come back here and close out this loan, and you get access back to the original collateral that you put up. So yeah, any questions about that explanation and how to kind of use Compound as a margin service?
No questions. There are some comments about crypto swaps being taxable and the fees, obviously, on Coinbase.
So the fees on Coinbase, if you're going to regular Coinbase, you're going to pay through the roof for that. So you'd have to be doing a large amount. But if you go to pro, pro.coinbase.com? That's kind of their trading side of things. It's a little bit more technical, but not by much. If you're used to exchanges and whatnot, pro.coinbase.com has significantly lower fees. There's still there are still fees for making that trade, but you could do a smaller amount and you won't lose as much to fees as if you're just using like the regular coinbase.com website. And you could also use Uniswap, assuming that the Ethereum network fees aren't through the roof. That's another option to do it. You don't have to use Coinbase, but that's just the example that I chose. So that's probably something that most people are familiar with. Andrew, the pro is better, but you do still have to pay the fee. It's just a smaller fee. Okay. Well, cool. So yeah, so that's lending. These are the two ones that I like the most. Obviously, there's quite a few more out there, but these are some of the ones with the most value locked into them, the most people using them, which means that they're kind of the most trusted by the DeFi community. And that's what you want, because anybody can deploy a smart contract. Somebody they cloned Uniswap and made Sushi Swap, and then the guy tried to run off with it, and then he brought it back, and it was kind of a weird thing where I guess it's okay to use now, but for a while there, it looked like the guy who deployed just literally cloned Uniswap, the most popular decentralized exchange out there, called it Sushi Swap, and then when he was able, when it got some traction, then tried to exit scam and sell a bunch of the tokens that were native to the platform. So yeah. I'm going to move on to the next bit here. So that's lending, and yeah, tune in next week to actually see a live demonstration of that, and I'll talk a bit more about it too. So if you have a question that didn't get answered in the lending portion tonight, tune in next week, same time, same day on our YouTube, and you can see me actually go through a live demo of that, and you'll have a chance to ask some more questions. But yeah, so on to DEXs, decentralized exchanges. As we talked about earlier, they allow you to swap a specific cryptocurrency or asset for a different one. And the two exchanges that I've listed here are Ethereum-based exchanges, although things like, with things like wrapped Bitcoin, which is just an ERC20 token pegged to the price of Bitcoin, you're able to profit from strategies that involve assets outside of the Ethereum network, which is pretty cool. So yeah, Uniswap is the most popular DEX on the market, and for pretty good reason. Their smart contract is pretty flawless so far. I should knock on wood when I say that. But in addition to easily swapping cryptos for other cryptos into and out of your wallet, Uniswap will allow anyone to create a token and list it on the open market for free. So if I want to make the OPI token, I can create it using a smart contract, program the rules in, like max supply, issuance rate, or something complicated like paying a dividend to holders. Then I can head over to Uniswap and I can list it. And the listing process is done through another smart contract that directly interacts with Uniswap, and it requires you to create what's called a liquidity pool. And this liquidity pool is set up to balance the price of the token based on supply and demand. And all you have to do as the liquidity provider is deposit an equal amount of tokens and Ethereum. So let's say the OPI token is worth $1. I put in 10,000 OPI tokens. I also need to put in $10,000 worth of Ethereum, not 10,000 Ethereum, $10,000 worth of Ethereum. It's got to just balance out exactly the price that I want to get for the OPI token, at least initially, and then the open market will determine what the true price is, and then other people are able to join that liquidity pool and put their own Ethereum and OPI token in to help keep it balanced, so that everybody's able to trade it with minimizing the slippage. And what's cool about being a liquidity provider is you can actually every trade on Uniswap takes I think it's a 0.03% liquidity provider fee, and that is paid directly to the people providing the liquidity in the pool. So if you want to, you can provide liquidity for the Ethereum basic attention token pair. So you put in $10 worth of BAT and then $10 worth of Ethereum. You are now providing liquidity, and you get a proportional amount of the liquidity provider fees when somebody trades into or out of that asset. So yeah, that's another way to profit, is being a liquidity provider. The downside here, though, is this thing called impermanent loss, which is kind of a misnomer because sometimes the loss is very permanent, but you'll see it referred to around the DeFi space as impermanent loss. But I saw somebody else was talking about it and calling it as divergence loss. So what happens is the liquidity is always going to be balanced. So the amount of basic attention token, I'm just using this as an example, the amount of basic attention token in there is always going to be worth the same amount as the Ethereum that's in there being used to trade for this pair. But what happens is when there's a lot of price volatility, you can actually lose out when you go to withdraw. After you provide the liquidity, there's a bunch of volatility in the market, and then when you go to pull out the liquidity that you've provided, you're going to get less out than what you've put in if the volatility is crazy enough. And there's ways to calculate this, and there's a rather it's not super complicated formula, but probably more complicated than what I want to get into tonight. And I'll talk about this a little bit more in the how-to section next week. But basically, you need to know if you're providing liquidity on Uniswap, there is a risk of impermanent loss or divergence loss. It can be very permanent, the loss, and it happens when there's a lot of volatility on the pair. So that Ethereum basic attention token exchange rate is flying up and flying down and going all over the place. You're going to have some impermanent loss. But the hope is that you're also getting those liquidity provider fees for the people doing the trades, so that will maybe offset or even earn you more than this divergence loss. Yep. So yeah, so that's Uniswap. Curve is basically the same thing as Uniswap, except it's geared for stable coins. So you're just exchanging like DAI for USDC or DAI for Tether or some other stable coin. And the nice thing about providing liquidity on Curve is because it's primarily stablecoin to stablecoin, there's not a ton of volatility because you're trading something that's supposed to be worth about $1 for something else that's supposed to be worth about $1. So there's not a ton of volatility in there. And I think their fees are a little bit lower because you don't have that risk of divergence loss. But if you're looking for another way to profit, that's a great way to provide some liquidity on Uniswap or Curve. Uniswap, you run a little bit more risk though in a volatile market of not getting out everything you put in. So yeah, any questions about that?
No questions.
Cool. All right, and yeah, again, if you think of something that you didn't get a chance to put in the chat, keep pumping next week's thing. You're probably sick of it by now, but yeah, you'll have another opportunity to ask questions about these same protocols. So with that, we are on to stablecoins, and I know Chill has prepared a great presentation on stablecoins and also the CBDCs, which is the government getting into the stablecoin game, and you need to be aware of it. And Chill's going to tell you why. So I'm going to stop my screen share here and turn it over to her.
Okay. And the chat is over to you then.
Okie doke.
So since it seems like, we have all the OG crypto fam at the moment, obviously you guys know that the concept of stable coins is nothing new. We had this in the traditional legacy system as well. Basically fiat currencies are stable coins. And on the international markets, we have seen this as well, where we have fixed exchange rates. And so those of you who traveled from San Francisco or Denver to Dubai, you obviously noticed that the dirham always happens to be exactly for each dollar you get exactly 3.667 dirhams. And that's because in 1997 they have pegged the dirham to the US dollar to keep the exchange rate stable, and it has been the same ever since. So this is kind of the exact same model that stable coins are trying to imitate, and obviously it has a huge importance because from the trader's perspective, they don't have to keep going on ramp and off ramp between crypto and traditional fiat currencies. So if you look at the current landscape, obviously at the beginning there was light Tether, and Tether was really a, a breakthrough in my mind, because it really helped traders to stay in Tether and be able to trade. And then more and more companies joined the fiat-backed stablecoin landscape. Some of the most popular ones, obviously Gemini, True USD, Paxos, and USD Coin. Matt has covered Maker, and he's going to cover that more extensively next week with the how to use and profit with DeFi. So BitUSD and Haven are some of the crypto-backed stable coins. And then we have, which is my favorite, actually, the algorithmic stable coins, and I will cover and kind of compare these next week as well, carbon reserve and basis. So when it comes to stable coins, obviously, and this is a very heated, exciting, but also scary area, because the governments obviously are looking to get in the game and create their own version of stable coins, which will be backed by what they say central bank reserve, which obviously all of you who have been in the space will think of, well, what is that? But yeah, they planning to get in the game with CBDCs. So what started, initially they were just looking at CBDCs, but this year, actually, with the pandemic, there was an accelerated interest. And the reason was because they had these stimulus checks, right? And so they had to distribute directly to people. And I mean, most of the world is laughing at us of printing actual checks that we were sending to dead people as well, because the central bank had no way of distributing this to people. In Denmark, you would have to take folks to a museum to show them what a check looks like. So their other goal was obviously to dematerialize money and create cashless society, by obviously this is their dream, to stop money laundering and also to have more control over the monetary policy by designing certain programs, and just bake that into CBDCs, or also to potentially program interest rate or automatic taxes. And we have seen that in communist China, they have been working on this for years now. And in October 2020, they launched the pilot program in, I believe, 5 different cities. So they're definitely coming out. And this is very important, especially for us, because this will affect the US dollar and the world reserve status of the US dollar once China has their own CBDC. So the question now, it's not if, it's when. And I'm very into researching these different CBDCs, and I will try to, I mean, depending on time next week, I will try to kind of give you guys overview of what's going on with each. But basically, Libra and the announcement of Libra by Facebook has been a catalyst for this idea. They suddenly realized, oh no, the private currencies now could potentially not just dethrone the US dollar, but become potentially more used and embedded in the global financial system. So there was an urgency, put an urgency on governments to now create their own. So besides China, which is obviously already happening, there are several other pilots in Uruguay, in Central America. And the debate is just a mess, to be honest with you guys. So they're trying to figure out, should this carry interest rate? Should it be anonymous? Because a lot of users have issues, obviously, if we're going to replace cash, that should be just as anonymous. So I should be able to send you, let's say, USD digital dollars without anyone else knowing. So should that be anonymous, and to what extent should be anonymous? Because obviously regulators don't want to see money laundering or other questionable activities done with the US dollars. Also, it becomes automatically international. So what if Venezuela decides to dollarize and start using our CBDCs? Like, how will they bake in these global sanctions into the CBDCs? How will these interact with each other, with crypto? And also, what technology should they use? So at the moment, they do not wish to use distributed ledger technology. So obviously, because they wish to maintain control over the monetary policy. Well, it gets interesting. So then, one of the other reasons for their desire to enter the space is to economize on cash management costs. At the moment, that's a huge expense for the central banks to obviously transport cash. And those of you who are familiar, obviously, they control the monetary, the supply of currency via M1, M2. So they would like to reduce this expense. And the final dream is cashless society, where they can control the monetary policy globally. They can bake in, whatever programs they wish to. The cybersecurity risks are huge. And this is where it gets interesting, because whenever you see their discussions, I recently just watched the Citibank CBDC pilot discussion, and one of their concern is, well, actually we should not create our own technology from scratch. We should use private public collaborations and call these digital payments hybrid CBDCs. So they're looking into that option. Financial inclusion. So at the moment, 22% of the United States, that's 63 million people, are either unbanked or underbanked, and 1.7 billion people globally are unbanked. Now, financial inclusion is not a concern of central banks, and well, I shouldn't say that. They don't have any interest to absorb the cost, the operational cost of providing basic banking services and bank accounts to folks if they don't have enough money, or if they don't meet the KYC requirements. So actually, CBDCs do not address these cost-related concerns, and they have no desire to solve this problem. So what was interesting is that initially, when they've seen, the popularity of cryptocurrencies and the fact that private currencies are in fact solving the global financial inclusion, they said, well, we cannot rely on private sector to solve the financial inclusion problems. Therefore, we need CBDCs. But also, after that, they realized that they need to use private sector technologies and innovation in order to actually launch these CBDCs. And they also have no plans at the moment of how to get these CBDCs in the hands of the users. So they are planning to rely on private sector to distribute CBDCs. So I think this is going to get really interesting. We will see if they will interact with current cryptocurrencies. We have to see what technology they choose to go with, and how will obviously China's CBDC affect the USD, and should we short the dollar? A lot of the wealth management companies are discussing that possibility as China is closer and closer to actually, distributing their own digital yuan. So with that, I will kind of recap. So I'm going to cover some of the algorithmic stable coins next week, following Matt's how to use and profit with DeFi demonstrations. And as you can see, this is something that we need to keep an eye on, how aggressive they will become, how will they regulate, the current crypto space. Some countries may over-regulate it, other countries may just start working with it. So this will either way affect DeFi. It will affect, basically every aspect of our financial future. So I'm definitely keeping an eye on it. Any questions? Matt?
Oops, sorry, I was muted. Yeah, I think everybody is kind of on board with you. There's a lot of bashing of CBDCs, and yeah, people are kind of worried about it being centrally controlled and go into war on cash. And yeah, I think too, I would add the invasion of privacy. I mean, if everything you do is run through a CBDC and it's on a blockchain ledger, they're going to know exactly what you've been doing, exactly who you've been interacting with, and it's basically, the days of giving someone paying cash for something and retaining your privacy are going to be gone. So I think that's something I would add to what you've said. But yeah, time's going to tell. They're going to have to use the private sector, and because the government is not very innovative. And are they going to overregulate? Are they going to try and take over? Are they going to play nice? It'll probably be a little bit of all three, if I had to guess. But yeah, time will tell, and it's a good primer on it. And yeah, and so the stable coins that we're currently using today in the DeFi ecosystem may be the CBDCs of tomorrow. It's possible. So yeah. So that's gonna do it for tonight. I know, Chill, if you've got a skedaddle, go for it. But I wanted to give everybody a final chance to ask any questions that you didn't have answered, or if there's something in the presentation that you're wondering why we didn't cover, or some platform or something. Now is a great time to ask them. I'm going to hang out here for another 10 minutes until 8:30, unless there are no questions, and I'll just go eat dinner. But yeah, so if you had something, if you've been listening, remember, I mean, even if it's super basic, like, what is DeFi? That's totally fine. We want to make sure everybody's learning at least something. I'm not going to be offended at all. We'll give it a couple seconds here. I really like Monero. Somebody said Monero. I love Monero.
Yeah. So actually, Matt has a surprise regarding privacy next week.
Should I spoil it a little bit?
No.
Should I hint at it?
No.
Should I hint at it? Well, I mean, let's see here. I'll say this. If you haven't already, maybe go check out our last video we did with Beam, BEAM. Just go give them a watch, and then you might be able to guess what the special surprise section is for next week. That's all I'll say. Oh, we got a question. Are there any DeFi or blockchain technology that can be used for privacy? I don't know, Chill, you want to take that one?
Are there any DeFi or blockchain that yes, and that we are gonna cover that. We actually have an event coming up regarding that too. So yeah, we're super excited, and not just because privacy is near and dear to our heart, but because I personally believe that these large wealth management companies don't wish to have all their trades and all their skeletons out in the open. And as much as I respect, the Ethereum project and what they're doing, I think it's just a little bit too open for some companies. So I think,
the big players.
yeah, the big players.
So yeah. Thanks, Jim. I'm glad you learned a lot. We hope you tune in next week again, same time, same place, on the YouTube here. So yeah, if you want to follow us on Twitter or subscribe to the YouTube channel, you will be notified when we put out the link for next week. But it'll be December 17th, 7 p.m. Denver time, on the Thursday there, and be about another hour and a half, maybe 2 hours, just depends on how many questions we get. But yeah, I don't know. Have you looked at Horizon? Is that, I'm not, is Horizon an exchange or is it a protocol? I don't think I'm familiar with Horizon. Or is it a crypto? OTC is over the counter. So if you don't want to like sell $10 million worth of Bitcoin or buy $10 million worth of Bitcoin and like run up the, just screw up the order books and run the price up and get a bunch of slippage, you just go in with, wire some money, do an over the counter deal and wire some money in, and then they just send the Bitcoin to you and it never hits the order book on the exchange that all of us plebs have to use. Horizon's a protocol. I'll have to look into that. I don't, trying to think. I try to keep it fairly basic, but I even know what they do. So maybe they do something basic and I'm just not aware of them. But yep. Oh, old Zencash. Nice. I actually had some of that. Well, yeah, it was like Z Classic, and then, God, what did it forked so many times. I don't even know. All right, Horizon is a coin. Gotcha. Okay. So yeah, I don't see any more questions. Yeah, I'm glad you all got something out of it. We were pretty excited to present this. I'm really excited to get into like the live, the live demos next week. I know it's kind of risky to do a live demo in case like, my internet goes out or like MetaMask decides it doesn't want to work. It can be kind of embarrassing, but I think it'll be good for everybody, and it'll be an opportunity. I know Zoom does some like workshop things, so I might be able to do like an actual hands-on. So if you want to come out and like follow along on your computer while I show you what to do, you can actually, if you load up your MetaMask with a little bit of Ethereum, you might be able to actually like open a position and get some like hands-on experience, which is, in my opinion, the best way to learn. So yeah, I think that's gonna do it for tonight. So yeah, we'll hopefully see y'all next week, and yeah, check out that Beam video if you're curious about what our special surprise might be for next week. But yeah, that's it, everybody.
Guys.
Thanks so much. Good night, and stay safe and healthy out there and all.